Okay, we move on. Well, I've been involved with this committee, and it was really fun to work with Franklin, Itay, Julapa, and Bill. It was really fun. Of course, the most burden was, as everyone said, was on Julapa. And I really want to thank her and give a round of applause for her to getting it all. And yesterday, Dr. Plosser talked about the simplicity, transparency, market forces. And this session is about the transparency. And do we need transparency? What form do we want transparency? How quickly we want transparency? And the way I liken this is we all go through the scanners when we get into the building. Suppose those scanners did a health profile to us and then, tells us what kind of health conditions we are. And then when we all gathered here in the morning, suppose Julapa comes up and says that the scanner gave us the report and half of the conference participants had contagious disease. So do we want such information to be shared? What kind of impact that would have, on our behavior and so on? So we're going to be talking about those things. We're going to have a very good set of speakers here. First, Itay has been sitting there waiting for me to finish. Prematurely stood there. So he's going to talk about theory of value of information. It's a good thought piece, like other work that he works on. Then Pavel is going to talk about a specific piece of information, namely stress testing, which a lot of people are stressing over. And will stress test prevent crises and so on, which I think is not the objective. Does it lead to some useful information is really the focus. And Pavel and Oscar's paper will focus on that, whether that reveals some usable information. Then Bill will talk about from the regulator's point of view. And Till is interesting. He was a regulator, now in industry, so he's seen both sides. So he's going to share us both sides of the world without tiring Itay. He's nervous there. So Itay, okay, you can start. Thanks.
Okay, thank you, Haluk. So the title of the talk is Stress Tests and Information Disclosure, and this is based on a paper with Yaron Leitner, who is here at the Fed and is sitting right there. Of course, the views here are not the views of the Philadelphia Fed, but the authors. I think the motivation for this paper is fairly clear, and it was covered yesterday in the keynote speech of Charles Plosser. So one of the key things that the Fed is going to do going forward after the financial crisis is to have financial institutions, key financial institutions, go through stress tests on a regular basis. One of the key ingredients of this new policy is that the results of the stress tests are going to be disclosed publicly. This aspect of disclosure is one that generates a lot of public debate, and you have here a couple of quotes from the Wall Street Journal from 2012, where Daniel Tarullo, one of the Fed governors, says how important the disclosure is. The disclosure of stress test results allows investors and other counterparties to better understand the profiles of each institution. But then people from the banking industry are a little more worried about that. And here the Clearinghouse Association is saying that making the additional information public could have unanticipated and potentially unwarranted and negative consequences to covered companies in U.S. financial markets. Okay. So in another review paper that I wrote with Haresh Sapra and just came out in Foundations and Trends in Finance, we basically talked about the various aspects of disclosure of stress test information. I think by and large, the benefits of such disclosure are fairly clear, and our review paper did not talk that much about that. I think most of us understand that in general, we want to have more information. We can make informed decisions that will be more efficient. But in that review paper, we also talked about some of the potentially unintended consequences. And we talked about the fact that there are ex post externalities that could reduce efficiency. So imprecise negative information can trigger a run, which can be inefficient. We talked about the fact that greater disclosure could have harmful effect on ex ante incentives. In particular, bank managers, taking into account the fact that this information is going to be disclosed, are going to take steps that are not necessarily efficiency enhancing, but are just meant to make sure that they pass the stress test. We also talked about the fact that when you provide more information to the market, you're going to reduce your ability to learn from the market. Okay, so those are just general trade-offs that we covered in that review paper that I think are quite relevant for the issue of whether you want to disclose stress test information or not. Now, I would say, and I will sort of touch on what Charles Plosser was saying yesterday, that there is a general theme behind all these issues, and this is kind of the theory of the second best. When you live in an imperfect world and you have many imperfections, reducing one imperfection, namely revealing more information to the market, is not necessarily welfare enhancing. Because this actually might make other imperfections worse. And if you want to think sort of about a general theme, why sometimes having less information is better, I would say that this is the general theme. Okay. In the paper that I'm going to present here today with Yaron, we basically build a new economic theory, a new model, where we're looking at another trade-off that is involved with the disclosure of stress test results, one that we think is quite important and has not been covered in existing economic theory, although it is related to some other work that has been done. Okay, so I have very limited time here, and the model is quite involved. So I will not be able to deliver the entire model like I would want and I would have done in an economic theory seminar, but I will try in the limited time that I have to sort of give you the flavor of this model and what we can potentially learn from it. Okay, so let me first very briefly describe the main issue, and then I will show you really the basic economic environment that we are considering, and with a couple of examples I hope I can convey the message of the paper. So the main idea is that when you disclose too much information to the market, you might actually harm interbank market activities or generally market activities. In particular, banks trade with each other, provide risk sharing to each other in the interbank market. They form networks, they trade risk, and this is in general best for all financial institutions. This goes back to a network type of model that Ali was presenting yesterday, building on the early work of Franklin with Douglas Gale. Okay. Again, the problem is that once you start disclosing information about particular financial institutions, these activities might be harmed. There is the well-known Hirschleifer effect in economics that we talk about. If you have different agents and they might be exposed to shocks, they would like to share the risk and trade with each other. But if you disclose the information on who is bad and who is good ex ante, then you're basically reducing those risk-sharing opportunities, and this is going to be bad for all financial institutions from an ex ante point of view. Okay, so if you take this Hirschleifer effect very strictly, the result will be striking that you don't want to provide any information. We don't want to go that far. We think this is too extreme. And in the model that we describe, we basically show that, you know, if overall things are kind of bad and the expected prospects of banks are not so good, then those interbank markets will not operate well. risk-sharing opportunities will not be available. And in those cases, you want to disclose some information to prevent a market breakdown. Okay? So basically, our conclusions from this study is that when things are reasonably good during, I would say, normal times, disclosure does not serve a very useful role. And it can actually be harmful. When you disclose information, you're basically interfering with risk-sharing opportunities, with interbank market trading, and you make the financial system worse off. But in bad times, when the interbank market does not work very well and risk-sharing opportunities are not easily available, then you would like to provide some information in order to get this market going. So overall, you want to provide some information, but not too much information. You don't want to provide information in a way that you will start interfering with market activities. So basically what we do here, we are going to derive the optimal disclosure mechanism in such a framework. And I will say, for those of you who are interested in economic theory, our results are very much related to a new line of work in economic theory by Kamenika and Gentzkov called Bayesian persuasion. Okay, so again, very briefly, let me just describe the economic framework that we have in mind. Again, I will not be able to go to all the details that we have in the model. So suppose that you have an economy with 3 dates, 0, 1, and 2. And suppose that every bank is characterized by a value, theta plus epsilon, that will be generated at time 1. Okay. We generally think about theta as being sort of the type of the bank, the strength of the bank, the fundamental of the bank, and epsilon will be some additional shock that the bank is exposed to and is idiosyncratic. Okay. So again, the value of the bank will be this theta plus epsilon, which is uncertain. Okay. Now, at time 0, the bank can basically engage in some trading activity in the interbank market and basically exchange the asset that it has, theta plus epsilon, for a market determined price X. Okay, so the bank can basically take this uncertain exposure and replace it with something that is certain, that is given in the market, that will be X. Okay, and X will be endogenous and is basically what interbank market participants are willing to pay the bank for its asset. Okay, so at date 1, the bank is going to end up with either theta plus epsilon if the bank keeps its asset and does not interact in the interbank market activity, or it will have X, which is certain and is again endogenous given what the market is willing to pay for the bank's assets. And again, if you look down here, you will see that X is essentially the expected level of theta plus epsilon given the information available in the market. Okay. Okay. Now, crucially, banks will have a desire to end up with an overall amount of capital above 1. So basically, we say that the banks are going to take whatever they ended up with, which we denoted as Z, and it can be either theta plus epsilon if the bank did not take part in the interbank market activity, or X if the bank took part in the interbank market activity. The bank is going to take this Z, and if Z is below 1, the bank is just going to have this Z, but if Z is above 1, the bank is going to have an additional capital coming, say Z plus R. Okay? Basically, what we have in mind here is that there is going to be some harm for the bank ending up with overall value, overall capital, however you want to think about it, below 1. Okay, so you can think that the bank will have some access to a profitable investment opportunity if it ends up above 1, or if the bank ends up below 1, there will be a run which will deplete some of the bank resources. But in general, there is sort of a benefit to ending up above 1. Okay. So what is the information structure here and the distributions? I will talk about this very briefly. So theta and epsilon will be drawn at time 0. Again, we think about theta as being type and epsilon as being noise, and the two of them are independent. The expected value of epsilon ex ante is going to be 0. Okay. Theta is going to be drawn from some finite set. So basically, we denote P of theta to say that this is the probability that we will get this particular realization of theta, and epsilon is going to be drawn from some cumulative distribution function f. Okay. Now, what is the information and the role of stress tests? And this is crucial. So we basically have in mind that a planner or a regulator, if you want to think about the Fed, you can think about the Fed, they will conduct this stress test, okay, and they will basically observe the theta of each individual bank, okay. The question that we will ask is how much of this information they want to disclose. Now, the market, the interbank market, is not going to observe theta or epsilon of any bank. As for the bank itself, we are basically considering two cases, one in which the bank does not observe theta or epsilon. So basically the Fed, in the course of the stress test, discovers something about the bank that the bank itself did not understand before, did not understand very well. Or we also consider the case where the bank does observe theta but does not observe epsilon, so the information that is available to the Fed about the bank is also available to the bank itself. The implications for disclosure are going to be very different between those two cases. Okay, so again, our question is what will be the optimal disclosure rule, and we're basically thinking about the optimal disclosure rule that is going to maximize the overall surplus available in the banking system. Kind of think about it as the expected utility of the representative bank, okay? A disclosure is going to be a set of scores S, okay? And a function that maximizes the type theta to the distribution of scores, okay? Now, we're going to use this notation mu of S to be the expected value of theta plus epsilon from the point of view of the interbank market, given that the bank received this score S. So basically, once the Fed comes in and says, look, your score is S, and this is publicly announced, this will be the expected value of the bank from the point of view of the interbank market, and how much the interbank market is going to be willing to pay for the bank's asset to sort of take the uncertain exposure theta plus epsilon and give the bank this X. This will be the X that the interbank market is going to be willing to pay. Okay, so this is a bit dense, but this contains some of the important results. So let me go over it carefully. But again, I will not have time to cover all the details, unfortunately. So in the basic model where the bank does not have the information theta that the regulator has, essentially what we show is that disclosure can be thought about assigning one of two scores, okay? There will be a low score, S0, think about this as fail, and there will be a high score, S1, think about this as pass, okay? Now, a high score will basically indicate that the expected value of this bank is above 1, and a low score will basically indicate that the expected value of this bank is below 1. Remember, 1 is this critical level. Banks always, if they can, they want to guarantee that they are going to be above 1. Okay? In general, banks that find out that their expected value is above 1 will be very happy to participate in interbank market activity, because then they take an uncertain exposure which with an average above 1 and trade it with a certain value above 1, so they guarantee that they will be above this threshold. They will benefit from this additional value that will go to banks above 1. Okay, so basically think about it as follows: if you get this low score, you're kind of stamped as not being good enough to participate in risk sharing and interbank market activity. You're sort of out of the game. If you get a high score, then you're kind of good enough to participate in interbank market activity, or in the game, you can benefit from the risk sharing provided by the interbank market. Okay, so what are the results here? Well, if the expected level of theta is above 1, so ex ante banks are expected to be above 1, basically what we say is you want to let all the banks pass. So you give all of them a high score S1, you say all of you are good, and then they will trade with each other, guarantee each other, and they will all be benefit from the additional value R. Okay, so basically what this means is in those good times when expected level of theta is above 1, no disclosure is the best way to go. Okay, if you start disclosing, you're going to say some banks are good, some banks are bad. You're basically interfering with interbank market activities. You're reducing those risk-sharing opportunities in the interbank market, and you're going to harm all the banks. On the other hand, when the expected value of theta is below 1, if you don't provide any information, the interbank market is going to fail, because now all banks are expected on average to be below 1, so they cannot insure each other and make sure that they have this certain asset above 1. And here what you would like to do is you would like to provide some information and basically enable some interbank market activity. So what you will do here is essentially you will assign a high score S1 to a few banks such that overall the expected value of banks with this score is going to be 1, and then the rest will basically fail and get the low score of S0. Okay, so this is when you would like to provide some information, but not too much information. Just to give you a flavor, let me just very briefly show this example, and then I will completely run out of time and have to conclude. So let's take the following example, and this is an example of normal times. Suppose that we have three possibilities for the type of the bank, 0.8, 1, and 1.2, and they happen with equal probability. So you can see that on average, the expected theta is 1. Okay? In this case, you don't want to provide any information. If you go out and tell the market, look, this bank is 0.8, this bank is 1, and this bank is 1.2, you're basically excluding the guy with 0.8, and you're harming overall efficiency. So here, if you don't provide any information, the market will just do its own. They will trade those risks, and all of them will end up with an expected with an asset of 1, and will benefit from the additional value. Okay, so here you don't want to provide any information. But now let's think about bad times. So here there is an additional bank. So now we have one guy with 0.6, one with 0.8, one with 1, and one with 1.2, and they all happen with equal probabilities. If you do the math quickly, you realize that the average here is 0.9. In this kind of environment, the interbank market is going to collapse because they cannot trade claims in a way that guarantee that they're going to be on average above 1. So here what the regulator would like to do is come in and provide some information. But you don't want to provide all the information. If you come in and say, look, this guy is 0.6, this guy is 0.8, this one is 1, and this one is 1.2, then the 0.6 and 0.8 are going to be excluded. You don't achieve the optimal outcome. What will be optimal to do here is maybe to come in and say, give a pass grade to the 0.8, 1, and 1.2, and a fail grade to the 0.6. So essentially, you're pulling someone who is below 1 with the others who are above 1. You enable those three banks to benefit from interbank market activities, and you're only excluding 1 from the interbank market activity. So under some conditions, this will be the optimal disclosure rule. Okay. So this is just a flavor of what this model can generate. I will say that things get more complicated when banks also observe their types, but generally the general flavor is also the same. Disclosure is better in bad times than in good times, but here you would need to have more signals, more scores in order to make sure that everyone is willing to participate given their known type. But I will not have time to go into this. Let me conclude. So basically what we say here is that during normal times, no disclosure is necessary. Essentially, disclosure can only be bad because once you disclose, you're interfering with interbank market activities, and this goes back to the well-known Hirschleifer effect. However, during bad times, some disclosure is going to be needed in order to enable the interbank market to operate. What we basically showed is that what you would like to do is you would like to pool some bad banks with some good banks so that you enable trade among them, but then you would like to exclude some bad banks so that on average those that participate in the interbank market activity are sufficiently good to enable such risk sharing to occur. So again, the bottom line is no disclosure in good times, but some disclosure, not full disclosure in bad times. Okay, thank you.
Morning, everyone. I'm Pavel Kapinos, and this is joint work with Oscar Mitnick, a colleague at the FDIC. I'd like to thank the organizers for inviting us to the talk. And before I start talking about top-down banking stress testing, I wanted to point out that there is quite a bit of skepticism about the nature exercise, and Professor Allen summarized that skepticism well just a short while ago. This may not be verbatim, but very close. When you do stress tests and feed all these macro numbers into them, he said, they don't mean very much. It's always encouraging when one of the leading people in the field makes a statement like that before your talk. But the Dodd-Frank Act has mandated stress tests. It looks like they're here to stay for quite a while, and the main objective of this paper is to show some techniques that hopefully can get a little bit more information out of the exercise and render it more useful. So let me... Oh, I need to mention the caveat. It's here in writing, but the views expressed in this paper are only ours and do not represent those of the FDIC. I should have looked at the camera and maybe raised my hand when I said that. Policymakers and practitioners have been interested in stress testing for quite some time, and they're interested in ensuring the resilience of the financial system and institutions when faced with extreme adverse macroeconomic shocks. The Dodd-Frank Act that was passed in 2010 mandates stress tests of individual financial institutions. There's been quite a bit of work on the CCAR exercise that applies to the bank holding companies that have over $50 billion in assets being employed by the FDIC. We're also very interested in what happens to the smaller banks, those with $10 billion in assets and above, that undergo somewhat less rigorous DFAST stress testing exercise. And we define stress testing as informative if it depicts a credible ex-ante picture of expected losses to the financial system in general and identify banks that would be in trouble under extreme macroeconomic stress. And along those lines, the effects of macroeconomic shocks can be studied at two levels. One is the effect on the overall banking system and the effects on individual financial institutions. And in this paper, we focus on both. There are two main approaches to stress testing. One is bottom-up, and that goes at the highest level of granularity of the data, studies the impact of shocks on individual loans, then aggregates them up to categories of assets and liabilities, and then aggregates them up to individual institutions. Our paper falls within an alternative approach called top-down, where the analysis happens at the more aggregate level. For instance, general income statement categories of banks, and studies their responses to macroeconomic shocks. So far, most of the literature has focused on the large bank holding companies, and again, we expand this set of institutions to include some of the smaller banks. So far, the evidence on the relationship between macroeconomic and banking variables has been at best mixed. I think generally people find fairly little systemic response of banking variables to macroeconomic activity, and point out that for some individual institutions, especially those who are in the left tail of the distribution, the response can be quite large, and we would like to provide a more general framework for studying some of these effects. So our focus is from the regulator's point of view for assessing the resilience of a wide cross-section of banks, wider than has been previously considered. We focus our analysis along cross-sectional lines on bank heterogeneity and compare bank by bank versus panel data results, and provide some intermediate alternatives. And we also allow our framework to capture nonlinear effects, because presumably in times of extreme distress, the effects of macroeconomic shocks can easily become very different from what they are in normal times. So the main contributions of our paper is to propose a rigorous method for selecting relevant macroeconomic drivers of any given banking variable. In reality, the CCAR exercise provides many candidates for macroeconomic drivers, and that can be easily expanded with the available macroeconomic and financial series. We apply this method for stress testing purposes. We provide stress test results for a large number of banks accounting for their heterogeneity, and we aggregate individual bank losses on an industry-wide basis to show the impact of the stress testing exercise on the industry as a whole. We document relatively large losses in terms of the number of banks failing the stress test and the effect that the stress tests have on the industry's undercapitalization. We used the Color Report data starting in 2000 Q1. The selection rule for including banks in our sample is that they need to cross the 10 billion regulatory threshold for DFAST exercise mark at some point over this time period. We select only banks with at least 25 quarters of data during this period, because part of what we do is running bank-by-bank regressions. And we obtain an unbalanced panel of 155 banks as a result. To give you a sense of comparison, the work that has studied the largest bank holding companies has typically focused on 20-some banks. Stress test scenarios, baseline and severely adverse, come from the 2013 and 2014 CCAR exercise. To economize on space, we do not consider the adverse scenario. We project banks' capital by estimating models for two banking variables, the pre-provision net revenue, or PPNR, and net charge-offs. Some other papers have looked at subcomponents of these categories, and our method can be easily extended into that setting. Just haven't gotten around to doing that. And then we'll build projections for PPNR and NCO historically and under stress scenarios, and convert them to Tier 1 leverage ratio, because that quantity has been the focal point of the recent regulatory proposals. So let me briefly talk about some issues in the selection of macro variables, particularly in the stress testing literature, but I think some of these lessons can apply more broadly in banking. The CCAR scenarios include about 30 macroeconomic variables, domestic and international. We focus on about a dozen domestic ones. But the literature has not really addressed which variables to put in the stress test scenarios in the empirical framework. If you consider these variables and then construct their lags and then take polynomial transformations of the concurrent and lagged values of those variables, you will easily wind up with hundreds of possibly relevant alternatives to choose from. And we would like to propose a statistical method for selecting some variables from these candidate pools that capture the evolution of a particular banking variable well. Focusing on statistical significance, which is sometimes done in the current literature, may imply a loss of information contained in less significant variables. Large numbers of variables cannot be included simultaneously because a lot of them are highly collinear, and even if they weren't, that would limit the degrees of freedom. Different banking variables may be explained by different macroeconomic variables, so it doesn't make sense to keep the same ones throughout. So our approach to dealing with this issue is to create two pools of candidate macro variables from the CCAR stress scenarios, a linear one that contains current and lagged values, and a polynomial one that adds quadratic and cubic transformations to the set. We first regress a banking variable, PPNR or NCO, on its fixed effect and its lag to obtain a residual variation. And then we run this elastic net regression of this residual variation on the entire pool of candidate variables. And to give you a sense of what the elastic net approach entails, it essentially minimizes an objective function that is a combination of the standard residual sum of squares and some penalty term on either quadratic slope coefficients or their absolute value. And so this penalty term essentially makes sure that the coefficients of the irrelevant variables are driven down to zero. We have a grid search that allows us to identify these variables. We take them out of consideration and extract the first principal component factor only from the set of the remaining relevant variables. And again, to give you a sense of the numbers, from about 55 variables in this set and 165 variables in this set, the number of relevant variables drops down to about a dozen in each of the considered cases. And then I think we make a small contribution to the literature that uses principal component analysis to construct indices of financial stress by showing how using historical rotation and rescaling matrices from the singular value composition that goes into the principal component analysis to construct historical paths of relevant variables. In our case, it's important because if we didn't do that and instead applied the standard principal components analysis on the historical data plus all three scenarios, we would get three risk factors corresponding to each one of these scenarios. And with this change, we don't have to do that. Here is the set of the CCAR variables that we consider and how some of their lagged or polynomial transformations end up being relevant for either PPNR or NCO. And very quickly, surprisingly, it doesn't look like interest rates matter much for either. And in terms of real activity, real disposable income and real GDP growth matters for income and unemployment for charge-offs. Here is a quick description of our data. The dependent variables that we'll use in the regression analysis are PPNR and charge-offs, and you can see that both changed dramatically during the most recent crisis. PPNR plummeted during it, and charge-offs gradually built up and peaked at the very end, and actually a little bit after the most recent recession. That's shaded in light blue. And here is the policy variable that will use projections for the previous two variables to describe. So this is the tier 1 leverage ratio. There are two important aspects about this graph. One is that during the last recession, if you had lots of capital, you lost it. If you didn't, you didn't. And a caveat that needs to be made here is something that Professor Herring pointed out last time, is that these are accounting values, and accounting values lag economic values in times of stress. And actually, if you look at banks' failures or assisted mergers during this period of time, you will see that the last reported value for Tier 1 leverage was well above the regulatory threshold. And the second point that needs to be made here is that the whole distribution has clearly shifted up since the last recession. The industry has become better capitalized. Here are the series for our principal components. They seem to match what happened in the last crisis well under the severely adverse scenario. And if the peaks seem a little bit lower, it's because our measure indicates that the initial conditions are a little bit better. This is for the 2013 CCAR, and a similar picture holds for the 2014 CCAR. Our empirical framework includes running bank by bank and fixed effects regressions of this form, dependent variable on its lag, and some potentially nonlinear transformation of the stress driver, which is our principal component factor. We run this bank by bank. We obtain a very wide distribution of slope coefficients. Some of them come with the wrong sign, which implies that under stress banks are going to improve, which is probably problematic from the regulatory point of view. And the in-sample fit measures aren't that great. When we impose homogeneity across banks and keep beta and gamma the same for all of them, we produce very mild values of gammas. So under stress, there is not going to be a whole lot of response from these banks. And this is a finding that other people in the literature have documented. So we propose to strike a middle ground. We group banks by their balance sheet characteristics and Camel's ratings prior to the crisis, and then use a K-medians algorithm to form these homogeneous groups. And we show that this grouping strategy outperforms either the fixed effects or time series alternatives for both of our dependent variables. And now the coefficient estimates have the right sign, and for some groups, they're quite large. So we use fairly standard accounting rules to take PPNR and charge-offs to Tier 1 capital. I'll quickly highlight that we do this under two assumptions: a 0% growth in assets and loans, which has been frequently used benchmark in the stress testing literature, and 3% growth, which is the average growth rate observed in the most recent crisis. And so we make these projections and compare them against some regulatory minimum values. So the landscape is changing very quickly. With these regulatory thresholds. Only yesterday a new rule was improved mandating 5% minimum for bank holding companies and 6% minimum for IDIs. There are some proposals that Professor Herring mentioned yesterday that make the minimum rules plus buffer capital rise up to 10%. So 10% is sort of a very conservative threshold for a well-capitalized bank. And so historically, under the zero growth projection, few banks would have experienced trouble during the most recent crisis. That seems implausible. A lot of them would have gone under with the assumption, the more realistic assumption of 3% growth. For the stress tests, in the baseline scenario with zero growth, banks keep improving. With 3% growth, they stay steady. And the severe scenario shows no major changes with 0% growth, and the median bank actually falling below the regulatory threshold of 6% under extreme stress, which is a pretty big deal. A lot of banks are going to experience problems. And a similar, somewhat more benign picture holds for the 2014 CCAR. Another way of viewing this, I'll just focus on the 3% growth, is by looking at the empirical cumulative density functions. So in the most recent crisis, our method suggests that about 70% of the banks would have experienced capitalization problems. The situation with capitalization has improved. Going to the 2013 CCAR, the number falls to about 55% of banks, and further falls to about 35% of banks in 2014. So how big of a deal are these numbers? Because a lot of banks in our sample are quite small. We build these expected Tier 1 capital shortfalls, that is the amount of dollars that would be necessary to bring bank capitalization up to the regulatory threshold. And I'd like to focus on one number in the interest of time. You can see that things have gradually improved over time, and that consistently the 3% rule requires more capital than the 0% rule. But this number of about 670 billion seems pretty close to what the roughly 700 billion that was injected into the banking system during the most recent crisis. So what our very simple model with some of the very simplifying assumptions says is that with this injection, the banking system would have been capitalized at least 10%. We know that it wasn't. So in a way, this is a measure of conservatism of our projections. And now, if you take the same numbers and apply them to the 2013 and the 2014 CCAR, you get numbers that are smaller, but are still quite large at over 4 and 500 billion respectively. And so in our view, I'm out of time here. These numbers suggest that the stress testing exercise can highlight some of the existing vulnerabilities in the banking system. Thank you.
Thank you. Now we have Bill. And I always wondered where that $700 billion came from. So.
Oops, I messed up. Dan, thanks. I went to the wrong. Okay, thank you. Yep. Well, good afternoon. Glad to have this chance to talk with you. I'm going to talk this morning about the role of stress testing in the supervisory process. And what I'm going to try to talk about is not so much what's an optimal stress test and how to conduct what are the best models. That's certainly a subject of discussion, and Pavel was talking about that to some degree. But I'm going to talk more about what can we reasonably expect out of the exercise. What can we expect it to do, assuming we do it well. And that's a somewhat different and I hope useful question. I'm going to take on that task by, in the middle of my talk, asking the question, would having a stress testing regime prevented the financial crisis? And I think that's a useful conversation to have and a useful way of thinking about it, not because the answer yes or no tells us everything, but thinking through that question helps us think about what we can reasonably expect out of the exercise. So let me see if I'm okay. Good. So to start with, let me just go over a little bit about the context and level setting of the stress testing exercise. First of all, it's While we began it prior to Dodd-Frank, it is now part of the Dodd-Frank Act in terms of requiring enhanced prudential standards for large bank holding companies and non-bank companies designated as systemically important by FSOC. The Act, of course, is very, very broad, and there are lots of things to talk about. I would say the principal elements of those enhanced standards are higher capital and liquidity buffers, with some restrictions on activities, particularly the Volcker rule, stress testing, and I would say those three are primarily aimed at the issue of enhancing resiliency and protecting against bank failures or large financial failures. And then new resolution mechanisms, which are meant to answer the question, even if that doesn't work, then what? And that, of course, is very important. There are spillovers. They're not completely independent things, but you can think of them, one as preventing lots of failures of financial companies, making them more resilient, and the other, what do we do if that doesn't work? So just as a brief history, the SCAP exercise in 2009 had it was a supervisory, well, I won't say purely, but predominantly a supervisory exercise where for the really first time that I'm aware of, supervisors said, here's the number that we see as your stress capital level in a quantitative modeling way. And if you don't meet it, a set of actions now follow. In particular, at that point, it was raising capital or capital injections by the government, and then substantial public disclosure of those results. That also was unprecedented in behavior. By the way, what was not unprecedented was the idea that banks were supposed to hold capital for stress. Sometimes that language gets confused, but the regulatory requirements were always that banks were supposed to hold capital levels to withstand stress. But this was a way of implementing it in a real way. Beginning in 2011, we began having the Fed doing these stress tests on a regular basis as part of a rule, and they've been happening for the last several years. And at some point, the Dodd-Frank Act required those stress tests. And there's a subtle difference between the Dodd-Frank stress test and the so-called CCAR exercise, in that the Dodd-Frank stress test, and you'll see these two different publications, looks at a pro forma way of looking at dividend distributions and capital distributions, where the CCAR exercise asks the question, are we okay with the planned distributions by the firms? And so it looks at that. And the second thing is the CCAR exercise has an important qualitative component where we assess the capital planning of the firms themselves. So here are the critical elements, I would say, of those tests. One is they are an independent supervisory estimate as a component of those tests. This is very important to understand. The traditional way of doing supervision was to look at what the banks did, try to critique it in some way, and assess whether it was sufficient. Having your own independent analysis as part of the process is very, very important. These are bottom-up models, as Pavel mentioned, but very importantly, they are industry models rather than firm-specific models. What do I mean by industry models? They have the characteristics of the firm portfolio, so each firm has its own individual portfolio, but by and large, they do not look at effects that can be traced to different management behavior or different firm-specific effects that happen across time. They are meant to capture the underlying quality of the portfolio, and insofar as different management teams handle that portfolio differently, they are not meant to capture that. That's supposed to be done through the supervisory process. The other important thing is they are actually tied to some outcome, and in this case, decisions on dividend payouts and other capital distributions by the firm, and there's substantial public disclosure. So what are some of the major positives I've already mentioned? Independent assessment is a really important one, and a major shift in what was done before, having an independent assessment. The other thing that's really very important is that it has required very substantial investments in data enhancement by the firms themselves. I think there's a strong argument that firms have incentives once having the data to use that optimally and efficiently to assess risks, but it's not always clear that they have the incentives to invest in much in the data and prevent particularly substantial financial problems, since they do not necessarily internalize the externalities they cause on the rest of the system. As a fact of the matter, it's pretty clear that the investment in high quality data was less than most people would have said was optimal prior to the crisis, and that had been a long-standing problem. The other thing I'll argue is that running bottom-up models of stress have the advantage of they identify risks and vulnerabilities in a way that top-down models, even if they came to roughly the same conclusion about the overall capital needs, cannot do. And public disclosure has certainly enhanced transparency and public confidence. And I realize Itay, in your own paper, suggests there can be too much, and certainly that's an argument, but certainly the public disclosure that happened over the last few years, I think, no, I didn't do that. My screen is gone. So, Dan? This is blacked out. I'll talk from... Okay, so I need to go back. Trying to go back because I clicked ahead and the screen went blank. Okay. So what are some of the potential downsides? Well, one, we are concerned that they'll push firms to just mimic what the regulators are doing. And there is certainly a strong incentive to that. Could add systemic risk by generating a common view and common methods. And by that nature, it can induce more systemic risk in the system. It could reduce bank attention to its own idiosyncratic risk profile. Again, now you're talking about resources. The bank certainly has reasons to look at that, but they also have certain amounts of resources they want to invest in their risk analysis. And so it can push them to mimicking what the Fed is doing. And even if we do not release precisely our methodologies, people kind of figure it out after a while. The other thing is that positive stress tests might be seen as certification by the regulators. This is in some senses always true if regulators are not taking supervisory action. People will say the regulators are good with that firm. But we do not want the stress test to be a substitute for risk analysis in the way that Moody's and S&P and other ratings became a substitute for risk analysis. We do not want to become the new Moody's and S&P for bank analysis. So I said I'd get to this question. I think it's an interesting one. Would stress testing have prevented the financial crisis? And so in talking about that, I am really bad at this. Dan? I think you should just stay up here. And why did that do that?
Well, once you get to the end of your presentation, it goes back to the...
But I wasn't at the end. Okay, let me go through. Sorry about that. So, first of all, what's my answer to the question? The answer is, in some sense, although it's not a well-posed question because we have to take all of the changes into account, higher capital, higher liquidity, etc., but not likely. And here I want you to remember the disclaimer on the first slide that these views are my views and not those of the Federal Reserve Bank of Philadelphia or the Federal Reserve System. Not likely in the sense of, in the following sense, and I want to be very clear about this, not likely in the sense that what would have happened is we would have ran a model and it would have said banks after stress were well undercapitalized. Again, assuming we had the old capital ratios and all of the rest. And why is that? And I think it's useful to think about it. Well, the reason why I think that's true, and I think I can show that it's true, is that risks were missed because, in fact, they were repackaged in ways that standard methodologies that were being used were giving the wrong answer. In the sense that you had to go beyond what you had done traditionally to find out and figure out what the problem was. In a shameless plug, I will say I talk about this in more detail in a paper I've done with Jalapa in 2010, and that goes into this in much more detail. But the important point is that repackaging was not, in fact, in my view, an accident. It's a natural dynamic that occurs both with respect to inside a firm and with respect to the dynamic between firm and regulators. That is, risks are going to arise precisely in ways that are not captured by whatever method is used to detect them. That's an evolutionary process. It is a process that happens within internal firms and creates agency problems within firms and happens between firms and regulators. Does that mean improving risk measurement and doing these stress testings is not beneficial? No, it doesn't mean that at all. It's sort of like thinking about putting a security alarm on your house. It makes it less easy to develop methods to get beyond those risk controls. But you'd still be making a big mistake if you left all of your valuables and assumed that nobody will figure out how to get around it. It'll just take more sophisticated criminals with better methodologies, but eventually there will be people who will find it. The other important point is that it enables you, if you do good quantitative analysis, to focus attention on where the significant blind spots or potential errors are. And this is very important because that is where quantitative analysis can play an extremely important role in saying what are the things we need to focus on to understand better and get either better data, better information, or understand how a business works in more detail. So let me go into a little bit of this related to the crisis. And very importantly, I want to talk about the crisis beginning in 2007, not the aftermath of Lehman. And this picture is just to demonstrate that there was a major shift, and particularly in the asset-backed commercial paper market and a collapse of that market in 2007, roughly the summer of 2007. And it's very important to think about that part of the crisis because in that case, there had been no major failure of a public firm. The housing market had been going down, but it was not a disastrous fall. At that point, the housing market had declined by about 7% by Case-Shiller. The point I want to make about that is, while there was certainly over-optimism about house prices at that point, most stress analysis that were being done internally at firms Freddie and Fannie, would have incorporated that kind of house price shock. So it wasn't that people didn't think about house prices ever falling, which is sometimes what people will say. So what was missed? Well, what was not missed was that there was significant inherent default risk in subprime mortgages if the housing market slowed down. Certainly by 2007, that was well understood. Actually, by 2007, it was actually manifesting itself. There was the 2006 vintage had fallen apart. I'm just going to I'm not going to go through them, but there are documents, and there are lots of them, that attest to worries about lots of defaults in the mortgage market. That was not really missed. On the margins, the extent might have been missed, but that really was understood. But what was the major misses? And they occurred both internally at firms and between firms and supervisors. Well, one was the true exposure, the concentrated risk exposure to mortgages, particularly through the structured finance securities and CDOs. If you actually look at how people were sizing their exposures to the mortgage market, they got it substantially wrong. And I'll just leave you with this one point about that. After the crisis, in a senior supervisor survey, it stated, this is I think 2009, that many large financial firms can still not capture their exposure to the mortgage problem. So if they couldn't do it by 2009, it's a safe bet they couldn't do it in 2007. There also was a misunderstanding of the amount of risk transfer in many of the conduits with backup liquidity facilities. So when people looked at their exposure, they said it was a lot less than in fact it really was, because they did not understand the features. Well, they either did not understand, they hid, or were not being honest about the exposure they had from those facilities. And lastly, I would say that there was some misunderstanding of the portfolio risk characteristics of bundles or portfolios of securities that are structured to obtain a rating, as opposed to a portfolio of securities which have a particular rating. It changes the nature, the portfolio risk characteristics, not just that the rating may be right or wrong, but the portfolio changes when you make up a portfolio of those kinds of characteristics. So I just want to do a couple of things really quickly. One is to tell you that prior to Lehman, the big losses were in write-downs and securities. This is a picture of bank losses. About 80% of them were in securities. A small fraction were in loans held on books. And if you took out IndyMac and WAMU, that ratio would go much higher. The second thing, which is very interesting, is that if you looked at an asset-backed CDO in 2006 versus 2000, you were talking about a completely different animal. Those two green bars to your left represent the percentage of mortgage-backed assets that were in an asset-backed CDO. The blue is what a CDO looked like in 2000. And you can see it's a very well-diversified asset with lots of different kinds of assets. By 2006, it's a different animal completely. It's basically a mortgage play by any other name. So if your analysis was, we're going to look at the historical behavior of valuations of CDOs, that's going to have nothing to do with what is our concentrated risk exposure to mortgages. It's going to be a completely different thing. So my point is, you can get to this by empirical analysis. Not that quantitative analysis can't get to these issues. It's you have to know something about the market. And you have to know why this would be missed when somebody shows you a set of historical valuations and time series of what prices are in the CDO market. that you'd have to know that that was irrelevant and some other kind of analysis was required. So what's the takeaway? The takeaway isn't just to say, well, you can't catch everything. That's true. The takeaway is that dynamic markets will generate risks that are structured to escape detection. Wharton argued that this when he talked about CDOs being too complex. I just would add to that point that this wasn't just a fact that they were too complex. This is what made them so attractive by many people inside these firms to do more of. Quantitative analysis, including stress tests, are going to be much more effective if they don't just give you an answer, but they're part of a decision process. They are part of a process of where do we put resources, what do we have to know, what greater information do we have to assess. I talk about this in another paper as the banker versus finance view of risk. And what do I mean by that? Well, and when I say finance, I'm talking about asset pricing finance. I realize there are lots of streams of finance. But people in doing asset pricing and looking risk at that look at a set of exogenous assets, and the data is there, and they try to estimate the stochastic properties and risk properties of those sets of assets. The traditional banker view was risk arises when somebody does something that they're not supposed to be doing, or isn't revealed. Bad underwriting, excessive concentrations that aren't revealed. If you're a trader, taking too great exposure. The point is both have a lot to contribute, because we have to remember the data that we are looking at when we're doing stress tests are created by processes, are created by human beings. So they are designed often to evade detection. What does that mean? It means stress tests combined with tougher requirements for capital and liquidity do increase resiliency, but we still are going to need to find ways to limit the damage when failures of large banks occur, because they inevitably will.
Okay, it's my turn to play with this.
You'll be much better at it, I'm sure.
Time will tell. All right. First, thank you very much for inviting me to speak here before you. And please also, Paul, excuse, I'm going to be hacking my way through this. I'm at the tail end of a winter cold and just at the beginning of a spring hay fever, so I'm getting the best of both worlds. So if you don't mind, let me first start with a very basic review of capital adequacy from a very simplistic view of a bank balance sheet, because I want to use that as a way to tee up all this stuff about stress testing and why we think it's a useful thing to do. So let me start over here on the left. Let's start out with a very simple view before we get into all this fancy stuff about risk weighting. We have assets. The bank holds a bunch of assets. It has liabilities that it owes. The difference in the kind of unexpected loss sense is supposed to be the amount of capital that it holds. 4% roughly is what we think of as the leverage ratio, so that's in an unweighted sense. Now, not all assets are created equal, and so we have these formulas that we've developed, and they're evolving quite rapidly about how we might parse the left side of the balance sheet to figure out, well, what's the right amount of capital really when we think about controlling for risk, and then we get something called risk-weighted assets. So this is the basic kind of regime that we're operating with entering the crisis. So let's look at the crisis. And I'm just going to sort of introduce this by looking at the TED spread. TED spread is perhaps one measure of interbank fear, and in that sense, some metric of what at least the capital markets think of the health of the banking system. And indeed, as Bill reminded us, the crisis actually started back in 2007, when for the first time the TED spread really went to unprecedented levels. So if you look at, if you look at the time series, this just goes back to 2005. But if I were to stretch that back another 10 years, it wouldn't look really much different. And in fact, if you look at the now last 4 or 5 years, again, doesn't look all that different. So let's take a look at macro stress testing in the early days. This really was a response to the failure of the old regime. Now, the embarrassing thing in the early days of the crisis, starting already in 2007, is that the banks had failed in the US and the UK. In the UK, their fund started in the middle of 2007, really at the end of the summer. They were all well capitalized by the existing standards, the standards at the beginning, this RWA thing. In other words, the formulas by which we parse and pass through the left side of the balance sheet. So there's a couple of reasons why that's really, really worrying as things start to fall apart. One is it's just so how do we then, faced with this problem, measure the health of the banks, recognizing that banks' balance sheets are more opaque than really the balance sheets of any other firm. And then secondly, it's also worrying because after all, the regulatory apparatus designed the very risk weightings, the very regime that in order to come to their own conclusions about whether or not the banks were well capitalized, that are now apparently no longer working. So not only was there uncertainty about the balance sheets of the banks, there was also a lot of uncertainty about whether or not the regulators knew what they were doing by looking at the balance sheet of the banks. And in that sense, the regulatory community really had to do something quite different to show, to kind of expose what's really going on underneath the hood, but also to demonstrate that they were willing to let go of the old way of measuring capital adequacy that clearly wasn't working, certainly in that instance, and in so doing regain the public's trust, to demonstrate that, as an old colleague of mine used to say, that adults were back in charge. So in the US in 2009, we got off, actually at the beginning of the SCAP season, we got off to a fairly rocky start when the Treasury Department announced that this program was coming in early February of 2009. The market, by the end of the day, it actually had dropped 5%. And the reason it dropped 5% is because very little detail was announced about that program. And it's not terribly helpful when in the middle of times of great uncertainty, you combat it with yet more uncertainty. Thankfully, that in the course of that spring, this problem was slowly resolved, and by the time the results were published in May of 2009, it really did put a line of the crisis, at least in the US. So why is that? So stress tests produced results. They produced genuinely new information about bank health and bank quality. And in the US case, 10 of the 19 banks were revealed to need $75 billion worth of capital. By the way, so Franklin mentioned earlier the Spanish case. Spain did a stress test in 2012, and the total dollar amount, in their case euro, but in dollars, was about the same. But Spain is only 10% of the US economy, so it gives you a sense of scale of what some of the European countries are dealing with. So in the US, it worked in part because it transformed uncertainty into risk. Risk I can deal with, uncertainty is a very hard thing to deal with. And it did so in large part because there was actually an enormous amount of information that was revealed, and for the first time revealed, unlike anything before. And I'll come to that, but already Itay has given us a sense for when is a lot of information important unambiguously. During a crisis, a lot of information is important about the health of the banking system. Again, not just to reveal genuinely what's going on under the hood, but also to convince the market that the guardians of the banking system are once again kind of in charge and know what they were doing. Now, the trouble is that Europe may not have this luxury. This is not something I'll go into, much interesting as it might be. And in large part because, one, there's no backstop. There's still an absence of a credible backstop, and two, because the credibility of the supervisory apparatus still remains in question. Okay, so the CCAR program was brought to you by the crisis and has become law now thanks to the Dodd-Frank Act. It's worked so well, we made it law. So I want to focus, first of all, on the first C of CCAR, the comprehensive. Its comprehensiveness is part of what makes it so, I think, powerful. It's not just losses, but it's also revenues. It's not just on balance sheet, but also off balance sheet. It's not just the balance sheet per se, but it's also the income statement. The idea very much is to have it encompass all risks that the banks face, those that are obvious, and demonstrate that you've thought about those that are not so obvious. With the last round, it covers 30 of the largest bank holding companies. That makes up about 75% of the U.S. banking system. So think about this. 3/4 of the U.S. banking system is now subject to regular biannual, semi-annual, stress testing. In the summer, they do it themselves. In the winter, they do it, and the Fed does it. No significant capital action can be done without it. So that means no increases in dividends, no share repurchase program. One of the reasons why it is so effective is because it goes to the very heart of what bank management cares about, what a publicly traded institution cares about, and that is the return of capital to its shareholders. Also, no significant M&A activity. That's no fun. That if you can't do any M&A activity without getting it approved. And in fact, you can be forced to raise capital if you fail. So you can be forced to raise capital today, even if by today's standards you're adequately capitalized, if in the projection you are judged to fail. That's remarkable. That's remarkable, and that is unlike the old regime. In that sense, as far as I can tell, it really has become the dominant tool for the Fed to assess safety and soundness of large institutions. And it's not just the U.S. banks. The large foreign banks are going to join the fund in 2016. And it's not just banks. The Dodd-Frank Act also created this Financial Stability Oversight Council. They're allowed to designate non-bank financials as being systemically important. We now have 3 in that list. And they are also going to be joining the fund in some form or another over the next couple of years. So in my view, it's really hard to overstate the impact and the importance of the CCAR stress testing program on the U.S. banking system. Let me just give you an idea of concretely what this really entails. So in other words, if you're in a bank, what do you actually have to do? And what you have to do is literally a dynamic projection quarter by quarter, because the scenario is given to you quarter by quarter, and you have to allow for that time dependency. And in that sense, also heterogeneity of profiles. Come on. Of the heterogeneity of the different macro scenarios. So it matters whether the stress is front-loaded or back-loaded. It matters whether you come out quickly or slowly. And indeed, you need to demonstrate that the regime, that the resulting, there's a control L, there we go, is sensitive to those differences in macro scenarios. You start with the balance sheet today. In order to get to the balance sheet tomorrow, you have to go through the income statement. That's not quite enough, because one of the things you have to worry about is, well, new stuff might come on the balance sheet. In a simple way, 1, because stuff has defaulted and rolls off, and 2, some stuff just naturally matures and rolls off. So it's not like you're dead in the water. New things come on the balance sheet. How does that work? You have to think about volume dynamics for the different asset classes. You have to think about pricing dynamics for the different asset classes. And at every step of the way, you check, do I meet the regulatory ratios that I'm interested in? So it requires really an amazingly nuanced understanding of all the different dynamics of the financials in your institution, which is not easy, but has been also enormously useful for banks in understanding their own risk management. So let me actually come to the papers that we that we heard about. Let me start with the Kapinos and Mitnick paper. So they looked at the call reports. They looked not just at the top, the CCAR program banks, those 30, but a much larger universe, all those above 10 billion. Makes up, I think, about 85% of the banking system. So with the CCAR program, you've got the bulk. You add a little bit by going down to the $10 billion level. For me, there's a couple of things that really stood out. And the first one is that heterogeneity really matters. This pooled regression approach that, if not, that is, we don't know if that's exactly what's going on behind the scenes, but it's probably not a terrible first order approximation, really hides the distribution of segment-specific and even indeed firm-specific coefficients. And the thing that distressed me most is that some of those coefficients are of different sign. Now, we can debate at length about whether the signs are credible or not. We can debate at length whether or not the signs are different signs or even just different values of the coefficients are due to better management. That's going to be hard to tease apart. One of the things that was most probably due to is heterogeneity in underlying business models, because if you look at the ecosystem of banks, their business models are actually really quite diverse. It's very hard to compare, for instance, a nice, sort of a standard regional bank like KeyBank or Regions Bank or State Street, SunTrust, to one of the specialized institutions like the custody banks, State Street and Bank of New York Mellon, or specialized monolines like Amex and Discover. So these are, or capital markets intensive institutions like Goldman Sachs and Morgan Stanley, where in fact the income dynamics are often rather divorced from the balance sheet dynamics. So that heterogeneity, I think, is in part addressed by Pavel's paper by looking at essentially you develop clusters, segments. I don't know, though, if those clusters or segments in some sense correspond to or correlate with business models. I think that would be a natural thing to sort of think about because it would provide a nice intuitive explanation. It's also hard to miss, I don't know if you described this when you gave the discussion, there's a good times, bad times regime. And that makes it challenging in no small part because even as the banks develop their own models, by construction, most of the data is in good times. And so there's this need to draw inference on the tail by looking, while recognizing you don't have very much data from the tail. And then finally, what struck me also is that the CCAR state space that's given to us is not nearly as high dimensional as we like to think going into that exercise. So Itay and Yaron's paper talks about a topic that's very, very near and dear to my heart, which is this question of, just how much should you disclose? Now, one of the things that I think is critical to take away from this paper is it matters when the disclosure regime should be really different in good times versus bad times. So let's go back even to the crisis, how the US solved their banking crisis. The underlying analytics, if you will, of the SCAP was arguably probably no more important than the actual process and regime of disclosure. Because it doesn't matter how good the work is. If you can't convince the market participants that the work in fact was done credibly, it doesn't matter. And Europe had learned that lesson several times in 2010 and 2011. So when credibility needs to be restored, when genuinely new information is required, you need to have high disclosure. But once that credibility is restored, it's not entirely obvious, and in fact, they show that it may be even detrimental to produce all of this information. I think these are lessons that we need to take very seriously. By the way, they build on this cost-benefit paper, which I think is a must-read in this literature. If you want to get introduced to this topic and have a way to think clearly about it, I very strongly urge you to take a look at that paper. So finally, they say what I also find interesting, that even in bad times there can be too much disclosure and too much information. So where does that really leave us? So first, I think one thing that I take away from this very simply is that stress testing unambiguously worked during the crisis. But even there are there are important nuances, particularly when it comes to the disclosure regime that matter. Stress testing as an ongoing supervisory tool, though, in good times, is, in my view, a very different animal. It's sort of, if you, at the risk of sounding very trite, more different than we think it is more different. It really is more different. So, for one, the supervisor, having reestablished their credibility, is really credible. And by that I mean really, really credible for the market, so far that supervisory pronouncements carry enormous weight. So the thing is, everybody knows this, and so therefore everybody behaves correspondingly in a strategic fashion. The strategic behavior of how to manage the disclosure, knowing that the Fed is going to have a particularly very detailed disclosure regime, I think is a really big deal. So my 2 cents of what to do, I think for those of you who have teenagers, I've got one, you know that they'll roll your eyes at you periodically when you give them just TMI, Dad. So I think in this case, we have a serious case of too much information. I really think we need to disclose less. Now, to be sure, I don't think that the banks need to disclose less. I think the supervisors need to disclose less. So I think, to be specific, except post-stress minimum capital ratios, I think the disclosure component should only be at the aggregate level. So for instance, loan loss rates should be by category. Average loss rates for commercial real estate, average loss rates for credit cards. Because it will reduce, I think, the incentive to game. So lest you think I'm just pandering to the industry that writes my paychecks, I think actually the industry should continue to be forced to have a very rich disclosure regime, and in part so that allow the market participants to poke and prod them and to ask those hard questions, to say, why is it's a different dialogue. If you have a conversation with the CFO of a bank during earnings season, where you say, well, why are your C&I losses different and so much lower than what the Fed thinks your C&I losses are, versus why are your C&I losses different from what the Fed thinks the average, what that asset class is going to perform? Because there may be genuine differences. So nonetheless, you have the Fed's credibility, the supervisor's credibility on the asset class about how it might perform over the crisis, over this particular scenario, stimulating a very, I think, good and healthy discussion with the institution without getting down to what I think is a much less useful discussion and invites gaming of why is your number different what the Fed says about you. And I'll end with that.
Thank you, Ted. Well, it's interesting you say that the supervisors should disclose less. I wish, or maybe I don't wish, that Ed Kane is here. He would have a lot of things to say about that. We don't have formal discussion about the papers, but Till made some comments about both papers. I wonder whether they have any response to him, and then after that we'll open up for questions.
So first of all, thank you for the comments. We do agree that heterogeneity is a big deal, and the business model suggestion is a really good one. I think that is definitely that we'll have to add to the list of variables on which we group. We also feel that the good times, bad times regimes is a good way, is an interesting issue to explore. Our preliminary, very superficial work in that direction suggests that the bad times are concentrated in such a small number of quarters that it makes it difficult to estimate. But we'll try to do more work in that regard going forward. And I wasn't sure about the CCAR state space comment. Why is it as not as large as one would think?
Well, this is a comment about you observe high correlation amongst the macro variables.
Right. Okay.
So I just think about that as the state space that the banks operate in.
Right. And so our method actually tries to get to the true dimension of the CCAR state space by eliminating multicollinearity. But thanks.
No, thank you. I basically agree with what you said.
That is a great paper. Okay, so now comments. Before the session started, I was asked to ask you guys when you have a question to talk into microphones, so that because they're being recorded, but I don't see any microphones. So, well, so now there's one question there, so it doesn't help if you stay there. So, so Bob. Because I guess they cannot record if you just talk without a microphone. So.
I have an observation and a question on the disclosure paper in particular. First, it seems to me that there is an underlying acceptance of the norm that banking institutions fund themselves in the wholesale markets. And it seems to me that there's quite a bit of difference between temporarily managing a reserve position to meet required reserves and participating on a regular basis the way the institutions did, borrowing one day and acquiring assets with 3-month maturity in a highly leveraged environment. And I think it seems to me that's a fundamental question of whether we want to even accept that as a norm for financial institutions going forward. That was a major source of the problem. So it seems to me there's a fundamental acceptance of the fact that what was done in the past is okay to continue doing in the future. The second thing is there a risk with regards to this disclosure of, in good times, there's not a lot of disclosure. Suddenly, the regulators realize we're in a bad time. They make a lot of disclosures. How's the market going to react to the fact that the regulators are now saying, uh-oh, we're in a bad time. Therefore, can't that generate a whole collapse of asset prices and essentially create a problem?
Yeah. So regarding your first point, I guess I agree. I would say that I think our model is more general than that, and basically what we say is that if you disclose too much information in a very broad sense, you can interfere with market activities, and I think you can put that in different market environments, and I think the general insight is going to survive. I think that your second point is actually very, very good, and this maybe calls for an extension of the model, because right now we specify it in a way that everyone knows whether on aggregate we are in a good time or a bad time. The regulator does not have additional information on that particular aspect relative to the banks or market participants. But it's true that if everyone knows that the regulator is only going to disclose in bad times and not in good times, and people in general don't know whether these are good times or bad times, then the actual act of disclosure is going to send a message that we are in a bad time, and this can be a negative. So there will be an additional signaling here that I think is interesting to think about.
We're over, so I'll have one more question. Larry?
I really liked Bill Lang's point that the stress tests get at the risks that we understand, and we need to be focusing beyond that on the risks we don't understand so well. I have a couple of concerns, though, about the process, as best I understand it, for identifying that. Mainly that it looks at institutions by institutions among those that we regulate. So there's the possibility that you'll look at it, you'll say, oh, this is a risky practice, but it's probably just this institution, so we'll deal kind of with this institution and not worry about the overall market, when in fact, as we have later learned, some very bad practices have become institutionalized in the mortgage market. The second thing it does is it creates an incentive to shift the risk obscuring process outside the banking center, outside the banking system. And here one might think of independent mortgage brokers as being an independent source of risk. So I'll have an observation in the form of a question. Wouldn't there be some merit in kind of systematically and periodically going through the major markets, the ones that could cause systemic problems, looking to understand how risk is being created, how it's being transmitted throughout the that market, perhaps paying a special attention to those that are growing very fast and or showing lots of innovation?
That's a very good question. I think in some sense exactly the point. There is certainly mechanisms to do that through the FSOC mechanism in terms of having the ability to, in principle, investigate those markets. And so that's something we need to make sure works well. But I think the process you just talked about is exactly right. It's exactly on point.
Can I just add one little thing?
Yeah.
So what the program actually gives you a very specific channel through which you introduce that, and that's the scenario, right? So even if you restrict yourself just to the universe of banks that you're stress testing, I mean, unless they become an irrelevant part of the financial system, you can design the scenario. Nothing prevents you from designing a scenario to introduce the kind of risks that emerge that you're thinking about.
Okay, with that, I want to share one piece of information and we're going to break. The role of JFSR in this conference is that we're going to have a special issue. And then some selected papers will be published in JFSR, going through the referee process, of course. And then when we have this special issue, we will send a copy of that issue for every participant in this conference. So hopefully we'll wrap this up in a year. So with that, I want to thank the session participants for their insights and sharing all that hard work with us. Thank you. Well, let's meet in 15 minutes, I would say. Yeah.
That's true. Yeah.